Добрый день. Меня слышно? Скажите, пожалуйста, или напишите в чат.
Слышно.
Хорошо, у нас преподаватель задерживается, но он в пути. Сейчас уже должен подойти, поэтому, пожалуйста, подождите, не отключайтесь.
Good morning, dear students. Can you hear me? Please let me know if everything's fine.
Yes, yes.
Perfect, perfect. I'm really sorry I was stuck in a traffic jam somewhere in between. It was there was no sense trying to catch up a subway, so I was just in a situation where I couldn't change somehow. Okay. While I'm trying to get the presentation, maybe you have one or two questions. I don't know, something important, which I shall know.
Yes, could I ask if you read Google comments on Google Class?
Yeah, actually, I tried to do so. I couldn't find them yesterday. I will do it today again.
Okay.
Within the evening, but when you did them?
I think yesterday or 2 days ago. So.
Okay. What is the topic?
It's just I uploaded essay, but I didn't press submit, and I only noticed it in the morning. So.
Then press submit. It will show me.
Yeah, yeah. I submitted in like at 5 a.m. So.
Why didn't you press submit?
I'm not familiar with Google Class, so I kind of forgot, I think.
Not a big problem, I suppose, but look, you have all the things to, I don't know, to Google. If you don't know something, you are much better than me in doing.
Yeah, I just didn't didn't knew you need to press submit.
Okay, but now you know, right? And then you
yes.
finalize, you have to submit,
Sure.
and if you did that on GoFormative, you just, as far as I remember, you still have click submit in Google Classroom just for me to let know. But
okay.
Of course, I will see that you did the task.
Okay, sure.
I don't know what's wrong with the techniques. It doesn't show me my presentation. It is trying to download that. Okay, I will try it again. Okay, it seems it works. Now I'll see. Finally. Can you see the presentation now? Okay. It's so slow. I don't know what's the problem. Okay. Can you see the presentation? Let me know, please, if you don't see it. Okay, just I will be a little bit faster, right, for us to be fast enough to see all the things. So just for you to give you a brief update on intermediate test, actually most of you done it nice, which is good. There was one person who actually somewhere submitted it very early and then disappeared. And but besides that, there are maybe three, 4 people who was just below the good enough mark, which is good to me. It seems like at least you got the idea. This is just for you to know what topics exactly was the lowest. So this is bottom five tasks. I will try to show you how to do them correctly next time when we have our last lecture, which will be online. But still, for you just to get the flavor. So if one of the top 5 is slightly less than 60%, it means that actually all the rest, all the tasks were mostly 2/3 or more correctly done, which I assume to be a good enough result. And the last 2 tasks, of course, is supposed to be a problem, and we will cover them in more details. I will prepare especially these 2 for you to be familiar with the decision. Okay, today's seminar number 3, we actually, most of the focus will be the evaluation tasks, and actually deal terms part 2, I was trying to make an anti-dilution task, but maybe you will tell me how far you are in the tasks I have provided you with in Google Classroom. whether you have any particular problems with doing, or it's just a matter of time, please let me know. Okay, this is the agenda. Actually, we will go through the evaluation methods. Most of those methods, at least those you see here, will be on in the exam task. Okay, it will be hockey stick, first Chicago, scorecard, which is of course the easiest one, the venture capital for 1 round, and actually 2-round valuations of venture capital method. Then we will cover the tasks which actually touch upon the cash needs of the company. And anti-dilution protection, this is something what is deliverable actually by you to Google Classroom. I will just ask you in the end whether you have the problems and whether we need to take this task into the last seminar we will be having. Okay, task number 1 is hockey stick method. Be prepared a little bit to do tasks today with me together. So remember, just for you, it's implemented in 3 steps, right? You specify the investment amount required from the investment. You specify a return on this investment, which multiple usually, or it might be provided in terms of IRR and the length of the period. So you have to compound that. And you calculate the market value at the time of exit using multiples, PE, for instance, or any other. And then you calculate the ownership, which is required for you as an investor in the business to have after the deal. Okay, let's. That was a slight reminder. Let's now have the task itself. Investment required is $10 million, and the expected multiple is 5x. Let's suppose we have expected P multiple upon the exit 15. Assume it will be lower than today. And the expected earnings, after tax earnings, of course, we use in P, is 20 million. And this is how you would be solving the task, right? Just to remind you again how it was in the lecture. So we will take investment amount 10 divided by the earnings itself after tax at the time of exit, and then we have to multiply it by your required multiple, which is in turn divided by the expected multiple upon the exit. And it will provide you roughly 17%. Okay, this is the task for today. Investor required IRR determines required ownership. Assumptions is the following. We are investing 5 million. The period after which we are trying to get out of the business, at least we expect to get out, to sell our stake, is 4 years. The task in exam might be either in terms of multiple or in terms of IRR. So here I provide you with IRR and just explain you how you have a multiple from that. So if you take IRR of 50% and you have a holding period of 4 years, you take 1 plus 50% altogether to the power of 4. It will give you a multiple a little bit higher than 5. You see it in the brackets, exact number. So this is what you should use it now. And our after-tax profit upon the exit is expected to be 10 million. And the multiple we should use still 15. And the question is simple. Actually, that would be one of the easiest tasks on the exam. What is the required share of ownership? And I want you to try to calculate that. And we will, of course, go through it a little bit. Just try to get 1.5 minutes to do it on your own. If you need, I can leave it in front of you. Please don't use the chat currently because it's disappearing and it's hard for me to find what you put there. I don't see the chat now, sorry. Oh, now I see. Maxim, you just do it. We'll see it in a minute, but just try to do it yourself, right? It's always much better. Of course, you will see the the answer and the correct answer. But still, remember, formula is easy, right? Two parts, you multiply them, multiples on one side, million numbers with millions on another side. Okay, I will go forward. At least you will try to catch up. So future value, if we take the current number we're investing, it's 5 million. We accrue it at 50% for 4 years. We have 25.32 million of future value. The future value of the company when we want to exit would be profit after tax multiplied by P ratio, and it will be 10 multiplied by 15, 150. And the share of ownership we will require if we will be using this formula. That will be the value of investment divided by the value of the company, right? In future, and we will get almost 17%. So again, the concept is easy. I have a capital I'm investing today. I have some required IRR on that, whether it will be in multiple already or something you have to accrue. You take the numbers, you get the final expected value of what you have invested today in the future, and the same in the future, at the same point in time in the future, you estimate the value of the business, and you divide one by another. Now let's move to more complicated, more sophisticated, and more actually time-consuming task, which is making valuation with first Chicago method. As far as I remember, unfortunately, it's a big text, but let's go line by line. So we invest in a venture project which already has a revenue of $2 million US. The company asks for 1.5 million. We understand that there might be different scenarios. We will consider free, success, sideways, and failure. In each of those scenarios, we have some assumptions. And in success scenario, we expect that the company will grow its revenue by 100% every year. So the CAGR will be 100% for 5 years. And then it will be a successful company. It will make an IPO in 5 years. The margin would be 16%. The P multiple will be 19. In a sideways scenario, the company will grow its revenue not that fast, but still there will be some growth. It's 35% per year per annum. The margin will be lower, and the multiple is also lower, 10 instead of 19. The last scenario is failure, and after a couple of years, after 3 years of attempts in increasing the business, we will stop it, and we will just distribute the remaining capital of 1.6 million. Let's say we will sell everything we have, computers, I don't know, some code or etc. We'll just have some small piece of capital out of the business, which is not bad, right? Because it might be zero sometimes. Given that we would be discounting all our cash flows, unexpected values from future to today at 40% IRR, and given that we have these 3 probabilities of 40%, 40%, and 20% for each of the scenarios, we have to calculate the required ownership today. And we understand again 1.5 million today. As far as I remember, that was something like that. So I will be gradually opening the page for you, but for you just to start reminding yourself how it should be solved. So we have revenue. We have those numbers for each of the scenarios. As far as you see, we're increasing this revenue for 3, 5, and 7 years for different scenarios. And in bold, you see the realization of each of the scenarios. So in case of failure, after 3 years, we stop. In case of success, it will take longer, 5 years. But in the case of sideways, it will take even longer, 7 years. And these are after-tax profit margins and earnings at liquidity, right? So what we take the revenue for particular line, right? For 5 years, it's right to the 5 years. For 7 years, right to the 7 years, and we multiply it by the margin. So we get the earnings at liquidity, which then we have to multiply by multiple to get the value of the business and do some math. Maybe you will try to do it for a minute, the next steps, and we will check. Remember, at success scenario, the multiple is 19, 1.9. At sideways, it's 10. Failure doesn't count in this case. So try to get these numbers, which should be below. Just 1 minute, and then we continue. Okay, I'm gradually opening up. So it's 19 and 10. We multiply each number by relevant another number. This is what we have. We have value of the company at liquidity point for each of the scenarios. Remember, for failure scenario, we have it in our task. It's 0.6. But these numbers are not discounted, remember, right? If we discount that to the present time, we will get these present values. Of course, success scenario is the largest part and the biggest number. Next one, we have probability scenarios. And here I will stop for another minute and will allow you maybe to complete the task. Maybe you will get the number. Not exactly, Konstantin, but okay. Oh, yes, that was another company. You were right, Konstantin. You were the first one. Actually, I had 2 tasks yesterday when I was preparing that. You were right, but it's not the percentage, right? Share ownership. It's just the expected present value. And now, having this expected present value today and having the required amount of capital, which is 1.5, please tell me what is the required ownership percentage in this case. This is the last step. You should take the capital you invest and divide by the value, same as in hockey stick method. But here is the difference: we do it in the present, not in the future. But the math is the same. So you take 1.5 and divide it by 15.01. Actually, you will get almost 10%, 9.99. So this is the required ownership with those assumptions we had in our task. So again, 3 scenarios. In each case, you should in the end get to the value of the company at liquidity point in time, which different for each of the scenarios. It's either 3 or 5 or 7 years. And from that period in the future, you have to discount it back to present. Weight it according to the probabilities, and then having these two numbers, the required investment and the expected present value of the company, you get the ownership percentage. Is the concept clear enough, or we have to go through it again? Okay, I assume it's fine, but anyway, don't hesitate to interrupt me. Now let's go to next method, which is scorecard method. As far as I remember, it's not difficult, but the idea is the following. You don't have revenue and you have to make judgments on different factors, right? And here's the task. We are an angel investor and we are proposed with the opportunity. We know that similar startups in our region are valued roughly above $2 million US. And we decided to use scorecard method because it's an early stage company, very much early stage, before we start negotiations on valuation. So we decided that we should weigh such factors as management team, size of opportunity, the product or technology itself, the environment with competition, the channel, distribution channels and marketing efforts, need for additional investments, and maybe other factors which might be of importance. In brackets, you have weights which you have to apply when you make calculations. And our perception is the following. The team is strong enough, so it's more than 1.25x. The opportunity size is great. The largest component is 1.5. The largest number we can assume is here. We already have some customer feedback, and it's good enough. It's not excellent, but it's good. So we have no reasons to put less than 1x here. But we still understand, despite the more or less good feedback and the great opportunity size, the technology itself is still raw. Let's assume we see that there are a lot of things to be improved, which means that it might take more time or more efforts, and unforeseen additional investments might be required, which for us is not a good idea, right? We will be diluted more with this assumption. So the question here is, what valuation should we use when we will be negotiating with founders of the startup? And this is the starting point, how you have to approach the task. You have the average value of similar startups, which is $2.1 million US. We have these comparison factors and weights. And for target company, we have these numbers already. Where I get numbers of 1 in other pillars, which are not in the task, you just assume they are 1. So if we have in the task particular numbers for particular factors, we put them here. If we don't have additional information, we assume them to be 1. So here I have all 7 factors. However, in the task, I'm provided only with 4 of them, as far as I remember. So it would strength of the team 125, size of opportunity 1.5, product technology 0.7, and need for additional investments is 0.5. As far as I remember, early feedback is good enough. It was provided, it was 1. So here, line 4 and 5, I just put 1 by default. And I give you a minute. Please try to calculate the factors in the right column, and maybe just sum them up to get closer to the answer. Okay. I will start opening the answers gradually. So you just multiply one by none, right? And you get these numbers. You sum them together. You get the number which is higher than 1, which means that the valuation would be higher than average, right? And you have to multiply this multiple of 1.13 by the average value to get the answer. And it is 2,373,000. This is the valuation you might start discussing with founders according to this method, right? We don't have revenues, we don't have required IRRs, holding periods, we don't discount anything from future to present or don't accrue from present to future. This is just the way you approach such tasks. Yeah, Konstantin, is 2.1 million in average of benchmarks or what? This is the average value, okay, average valuation of similar startups in the region. So Angel is supposed to be experienced enough or have access to databases. And he judged that this company at this particular point in its development cycle, with this particular team and product and maybe size of opportunity, is not the first one, most probably, right? They might be more or less similar companies. And these more or less similar companies, on average, valued according to the deal statistics as 2.1 million pre-money valuation, right? And you just take this number and you use it, but you adjust it for your judgment. So if you assume that the team is stronger and the opportunity size is bigger, most probably the valuation should be bigger. I mean, it would be fair to assume that the valuation of this company should be large.
Excuse me, I have one question. If we fail to find the similar startup on the same stage of the company lifecycle, and we, for example, find a startup which is quite more mature, maybe like 2 rounds more mature than our startup, first of all, we should discount this valuation, and then we can apply this method, right? In this case,
actually, you might use differently. So in this case, when you judge the really early stage, it's really more of art. As far as you see, there is almost no Excel here, right? Besides these 2 multiplications. So the idea is to start from somewhere, which seems to be reasonable, right? It might be statistics or startups in this early, like seed stage or early stage deals, in particular vertical or area. Or it might be the idea you just mentioned. So let's say you have a company which is number 1 and you assume this to be number 2. You already have the valuation of the first player. You discount it somehow back according to your expectations, and you might start using that. It all depends, but it's just, remember, this number of the valuation is just one of many pillars you will be discussing with founders. It's not something you will put on paper, put in stamp and say this number is correct, right? It's just part of the deal for discussion.
Yeah, but I mean, if our companies are in different stage of their life cycle, so first of all, we need to make them equal and bring them to the same like stage using discounting methods, right? It was
don't overcomplicate. It's so when you consider average value, you assume these companies to be on the same stage of the life cycle. Right? So if you try to judge on the seed stage startup, as in this case, maybe for you it's better just to take statistics on seed startup deals, which is quite hefty, right? It's thousands of deals per year, right? And you just separate those which are similar to you, and you just calculate the average or median or something like that, rather than trying to get more mature company and trying to somehow discount them back. I'm not sure this will provide you with better estimate, to be honest.
Okay, thank you.
And remember, Maxim, the more steps the company is ahead, the less is the number of companies there, right? So there are a lot of companies on the seed stage where the investors put money, angels, right? Most of them fail. Remember, on each step, only part of them get to the next round. So actually, having the statistics on early stage deals will provide you with, I would say, relatively more robust estimate of average value rather than trying to take several companies which are more mature and trying to discount them back. So you will have less points, which already distorted by your assumptions on discount. Okay, now I suppose we'll move on, okay? If no more questions on this particular topic. And here are the most interesting tasks now starting. So VC method of investment. Let's start just from the task. So we have the terminal value, expected terminal value of the exit of 100 million. It will happen in 4 years. We are investing today 10 million. And discount rate, which should be used, is 40%. So our required IRR for this particular case is 40%. Number of existing shares before the round, so the pre-existing shares, is, as always, 1 million for the ease of calculations. What we have to calculate is the post-money valuation, pre-money valuation, venture capital investor share, number of shares to get, and the price per share or PPS. Shall we go to the solution right away, or you want to try to do it on yourself maybe for a minute or two? Okay, try at least to start, okay, and we will continue. Okay, step number 1, we have to get the post-money valuation. The post-money valuation is the present value of the business, right? The future value is 100. We have 4 years and IRR is 40%. So this is what we do. We divide 100 by 1.4 to the power of 4. We will get roughly 26 million US dollars. The pre-money valuation will be post-money minus investment, right? So it will be roughly 16. Required ownership fraction by investor should be calculated as the amount of investment divided by the total post-money valuation. Remember again, we have business, we put additional cash into that. So actually we have to divide this cash by the total value of this business, included cash. So it should be post-money. So it's 38.43%, what we will require as an investor in this case. Number of shares we should get for the mathematics to bring us to this percentage ownership we get at the previous step is the following. It's X multiplied by F divided by 1 minus F. So we take 1 million shares and do some easy math and get 623,798 shares. And the price per share is 16.3. We divide our investment by our number of our shares. Actually, you will get the same number, right? If you will divide, if you will use other numbers here. So you see that the pre-money valuation is again 16.03 million. So I forgot million in step 2. But at the same time, the pre-money valuation is split by 100 million shares. So you will get the same number, right? And that was it for the easiest part. So if no questions here, we move next and have some more interesting stuff added to the task. Okay, I move on. Oh, yeah, sorry. Now let's assume that we have to account for option pool and next rounds of financing. So let's assume we expect that more people will be needed, more seniors should be hired, and they need some option motivation. So we have to account for 10% option pool in this case. And we assume that one additional round of financing still will be required before the company might have some liquidity event or the potential acquisition. In this next expected round, we assume that 15% will be issued to new shareholders, 15% equivalent to common stock. And remind yourself that then we have so-called retention ratio, which will be 79.05%. So which means that actually our ownership in the company will be diluted. And this is the factor we have to take into account. And we want to take this factor into account and actually get higher percentage ownership in the company when we invest, so that after this dilution effect, we still have the same percentage ownership upon the exit. So actually to have those assumptions the same exit value and ownership percentage we want to get in the end, but having in the middle some dilution things happening, we need to start with higher ownership fraction, right? And this higher ownership fraction will be 48.6% instead of, remember, 38.42. To get this fraction, higher fraction of share, fraction ownership, we should get more shares in our round, right? Instead of 600 or something, we have to get 945,601 shares. In this case, it means that putting same amount of money and getting more shares will give us a lesser price per share. And it is 1/3 cheaper in this case. Okay. Do you have any questions with regard to this part of the task? Okay, don't hesitate to interrupt or come back to this. Now we have a much more interesting and complex task, right? Something closer to real life. With some important nuances. So just a second, please. It seems that which prevents me. Okay, here's the task. I will give you a little bit more time to try to do it yourself. At least try to start doing. We consider an investment into startup and we want to exit in 5 years. The deal is so that in 5 years, the company will have EBITDA of $27 million. We expect the multiple for that business to be 11, which is not high. And actually, the company will be having net debt already at that point in time. Our risk-free IRR is 17%. And actually, we think that there is a 20% chance that every year that the company will not succeed. So the chances in general are high enough, but still we should account for that, right? Because we have our risk-free IRR, so we have to somehow account for the idiosyncratic risk of this particular investment. We also should keep in mind that the option pool of 15% will be needed and one additional round of investment will be done. Option pool will be 15%. The financing round will require 25% ownership to a new investor. At this point in time, the company needs $5 million, and we are providing that. Let's say we lead investors. We represent the group of investors. And the number of shares, as always, before the round is 1 million. We should calculate, and down into each cell, you will be provided with cells in exam to put the answer. You will not be choosing the right answer, you will be putting your answer. Numbers. So it should be post-money, pre-money valuation, number of shares we get, percentage share we get, price per share in around and retention ratio. This is one of the nuances which many somewhat don't take into account at first. So when you assume the future value of the company and you as an investor in equity, you have to judge on future value of equity, right? So if company has net debt somewhere in the future, you have to subtract it. Remember that. So if you use the multiple of enterprise value based on EBITDA, enterprise value is not only equity, right? It takes net debt into account. So again, the future value of equity in our case should be the enterprise value in the future minus net debt in the future. So what you have to do to take your EBITDA, multiply by the multiple on EBITDA, and subtract net debt. Only then you will get the equity future value of the company, not the enterprise value. The risk-free rate, so-called post-money. So it's an intermediate post-money, not the actual post-money valuation. That's actually discounted future equity value to today, right? So if we assume it takes 5 years, so we have to divide the value from step 1 by 1 plus 17%, which is risk-free rate, right, to the power of 5. We will get 115.4 million. But the true post-money valuation should be adjusted for the probability of success. In other words, we might get the same number using different IRR in step 2, right? So we can split these two things, this thing in two, I'm sorry. It will be the required IRR on a fund basis plus idiosyncratic risk, which here we estimate with probability of success, or you can get the high IRR, which already takes into account. But the idea is similar, right? You just try to account for risks. Each risk should decrease the value. So true post-money value will be adjusted post-money. And you adjust it by the probability of success during 5-year period. So you have to take 1 minus 20%, which gives you 80% per year. You have to multiply it 5 times. And this is how you adjust the post-money valuation. You will get 37.8 million of post-money valuation, which takes into account all the risks. It takes into account net debt, right? And it takes into account this. The pre-money valuation is the easiest part of the exercise. Post-money minus investment gives you 32.8 million. And percentage share is F equals I divided by post-money. You divide 5 by 37.8, you get 13.22%. Use the same formulas as we used before to get the number of shares. You will get 152,379 shares in this round with this assumption. Your price per share will be $32.81 per share. Okay, before we move on, yeah, the retention ratio is the same formula as we used before, right? We have to divide 1 by multiplication of each dilution effect. So 1 plus 0.15 or plus 15%, it's when we issue the option pool. And another effect is coming from the additional issue of shares in favor of new investors. Then you have to take 1 and 1 plus 25%. So here retention ratio is slightly below 70%. If we take this retention ratio into the equation, we actually should get not 13.22, but 18.09% in our round of financing. The number of shares, of course, should be higher. We just used another F in our calculations. We get 234,690 shares. And the adjusted price per share will be the result of the equation, 1 million divided by the number of shares. So here are the answers. So we were asked to calculate and write down in each cell corresponding numbers, which would be adding post-money valuation 37.8, the pre-money valuation number of shares here. Yeah, I put together 2, but it will be 1 and 2. Actually, you will have to put the second number, which takes into account the retention ratio. Same with percentage share ownership and price per share. The retention ratio you use is a separate cell in answer section. I assume there will be questions, so I go back. And please feel free to ask me. No questions, so please, if it's fine, we'll move on. But please let me know if we should go again for the steps, or if you have questions to a particular one of them. There is a technical mistake here, but I'm sorry, but yeah, but the answer is correct. I will show you. Actually, on step 11, I have to use not 1 million but 5 million. I will get the same PPS adjusted. It's just typo from this side. Yeah, it was just a typo. Shall we move on? Actually, that's one of the most difficult tasks in the exam. But now you have it, you just can repeat that and you're ready. And it will provide quite enough points. But it's much more realistic, right, than easy tasks we had before. So in future, the company might have debt, you have to account for that. You assume some probability of success. You know that you have to target particular IRR for your fund, right? And you take this as the starting points in your calculation. Okay, we move on, but please ask me if you have questions. The next task is 2 rounds valuation. So in this case, we will have 2 investors or 2 groups of investors putting money in different stages of the business cycle of the company, Series A and Series B in our case. So actually both early stage, but one more earlier than the other. And then now, let's just go for the task. There is a company. There are 2 rounds of financing: Series A, investor X, and Series B with investor Y. Investor X will put 5 million into the business. Investor Y will put 12 million into the business. Interestingly enough, they expect the same exit value in 4 years since the date of Series A round. So actually, investors X require IRRs 50%, but logically enough, investors Y investing later on will have lesser required IRR, which will be 40%. So we have Series A round 4 years before the exit time, and we have Series B round 2 years before the exit time. So most probably it is expected to be the acquisition, right? So as far as you remember, we saw this pie chart, most of the deals are being exited after this Series A-B round. And again, the number of shares founders have before these rounds is 1 million shares. We have to calculate 8 things and put them as an answer in exam. The pre-money valuation in Series A, number of shares to investor X in Series A. Remember, X is Series A. Price per share in each series, A and B. So on each round of investment, we have the price per share. They should be different, most probably, right? We also have to calculate the percentage share of investor Y. Interestingly enough, expected wealth of investor X upon the exit. So we assume actually 3 points in time here: Series A investment, Series B investment, and the exit point. The retention ratio for investor X, and having the expected wealth of investor X, we might calculate the money multiple on his investment. So if he put 5 million at T = 0, and he gets something upon the exit, we can calculate this multiple. And now let's move on. But maybe you will help me a little bit here. I can go through easily, but most probably you will just tell me what we are doing in each next step. But I will start with first step. So actually, in Series B, our post-money valuation will be discounted exit value, right, for 2 years. So if we expect the exit 150, we go 3 years into the past, well, I'm sorry, 2 years into the past, with required IRR of 40%, which is the required IRR of investor Y. And we get $76.5 million, the post-money valuation in round B. What is the next step? Can you please tell me?
Maybe we should divide the amount of investments of second investor by this amount in order to calculate the percentage of ownership.
Not that fast, not that fast. We have to do some steps before. So actually, we have to calculate the ownership of investor Y, right? Because as far as I get, you were talking about X. But first, we are working from future into the present, and then we'll be working from present into the future. Remember, it's like a cycle. So
yeah, sure. I mean, investor B.
Yeah, investor Y in Series B. Okay, I see. It's a little bit more complicated. Okay, Y and B and X and A will be the same. You're correct. Then we take the investment we put into the business in Series B round, and we divide it by the post-money valuation, right? The post-money is post-2. What we have 15.68% ownership. This is one of the answers already. And we know that after that, the previous investors, which are founders and investor X in Series A round, would retain only 84.32%. And this is another answer. It's a retention ratio, right, for investor X. Now we have to continue our movement into the present. But doing so, we have to calculate now the pre-money valuation. We can just subtract 12 million from 76.5, or we can multiply the retention ratio or the ownership of all previous investors by the post-money valuation. We will get the same number. And it will be 64.5 million here. And this number should be taken and discounted again for 2 years back into the present, but using the IRR of investor X, right? And it is not 40, it's 50%. So what we get the post-money valuation in Series A round as $28.68 million. Let's calculate the pre-money valuation here as easy formula, which is post-money minus investment. It will provide us $23.68 million. This is one of the answers we need to provide in our test. So actually, you see, it's one page only. And in your A4 sheet, it will be maybe 1/4 or 1/5 of your page, and you already have the answers. So it's not that difficult. It just takes time and calculations. Now, we know that investor X, in Series A, invests 5 million. He will ask for 17.43% ownership at his round of investment, right? We have to divide 5 by the post-money valuation. It will give us 17.43%. Given that we have a retention ratio, because there is a dilution effect, the Series B round, we actually, in the end, when the exit happens, we'll have lesser share ownership, right? We have to multiply our current ownership after the round by the retention ratio. So actually, upon the exit, investor X from Series A round will have only 14.7% ownership. The number of shares actually investor X from Series A round is getting is easy. We have to take 1 million, which is by default the number of shares before Series A round, and use standard formula, right? To multiply it by the percentage ownership and divide it by 1 minus percentage ownership. We will get 211,146 shares. That's another one of the answers to the task. The price per share will be easy calculated, dividing investment amount by the number of shares, and it will give us $23.68 per share. Remember, if you multiply it by 1 million, you will get the pre-money valuation of the round, which actually we had before. Yeah, or you can always check whether you make correct calculations, because you can get the answers by different mathematics. Now from here we go into the future, but we calculate the number of shares. So for investor Y in B round, the total number of shares will be not 1 million as for investor in Series A round, but 1 million of founders shares plus 211,146 shares of investors from Series A round. So actually, before the round, investor B will have 1,211,146 shares. And using the percentage ownership of Series B investor, we might calculate the number of new shares he will get in Series B round. And it will be 223 shares. And we use the same math to get the price per share. So the price per share in Series B round will be 12 million, which is investment amount, divided by the number of new shares. So remember, it's new money divided by the number of new shares, or it's pre-money valuation divided by the number of old shares. But with this pre-money valuation, it works only if you don't have convertible notes. Remember, right? Because the task with convertible notes actually makes it even more complicated. And that was one of the answers again. Now, interestingly enough, it's not the answer, but for you just to get the flavor how it will be reported to investors of investor X on Series A round. Let's suppose that was one of the early stage venture funds. This venture fund in its reporting package will show you the multiple of 2.25x on his investment. So he was investing 5 million. He will show you how much? 5 million to be fine. He will show you more than 10 million valuation of his investment. Of course, it will be 12 and a half, 12 or something. Total number of shares after round Series B will be 1,436,369 shares. So you have to combine all the shares, right? That was founders shares, then Series A investor shares, and Series B investor shares. The price per share then upon the exit will be easily calculated as exit value, which is 150 million, right? We already in the future when they exit, so we don't need to, of course, make any calculation from here. We take 150 million as valuation and divide it by the number of total shares of all the investors into the company. We will get the price per share as $104.43. Expected wealth of our investor X from Series A round then will be the number of his shares multiplied by the price per share upon the exit, right? And it will be $22,050,000. That was one of the answers. And the last answer is multiple on his investment. Given that he has invested only 5 and get out more than 22, we will have that the multiple on investment is 4.4. Try to remember the graph with statistics on what percentage share of investments provide what multiple, and you will assume that this was quite a good investment, right? Having more than 4x in 4 years, not bad. So here are our answers. Pre-money valuation would be 23.68. Actually, you don't have to put M in answers. It's just here. But on exam, use only numbers. Number of shares is slightly more than 200,000. The PPS is easily calculated. It's 23.68 again. The PPS in Series B is higher. It's 33.28. Percentage ownership of investor in second round is 15.68. The wealth of our investor X, expected wealth upon the exit, 22.05 million. Retention ratio for him is 84.32%, and money multiple on his investment is 4.4. You will have to put these numbers into relevant cells during the exam. And yeah, that was the previous two tasks was among the hardest you will have. So if you want, we can go back and look again. Just let me know which particular step was of most difficulty. Okay, now let's move to the next task then, and it's tasks about cache needs. They are much easier than the previous one, but still remember the idea we were discussing during the lecture. Here we have some numbers with cash, and the question is how much money does a company need actually? Be patient and attentive. Here you have free cash flows, not cash balance, right? Cash flow and cash balance are different things. So here, when you see the free cash flow, it means that you have to assume that here it can be compounded. 3.6. Wait a moment, Konstantin, we will see some. Okay. But to move forward with cash flows, we need a starting point, right? Let's say in this case, we are starting with a cash balance of 2 million, right? And then if you will add in this free cash flow for each year to the initial cash balance, you will see that the actual cash balance as of the end of each year is the following. It's a little bit different, right? Of course, this is the free cash flow each year, but not in year one, because in year zero. So in year zero, we have a starting point. The starting point is 2 million. So actually, we have to do an easy math to get the idea of where's the bottom in terms of cash needs. This is what we start with, and this is our deficit. And that's it. That's an easy answer. But just don't forget to look at E0 at year zero. The starting point is important. Should it be here 1, the year-free deficit would be minus 2.6, not minus 1.6. And here is a little bit more interesting task. Let's say you have different years and different metrics. Let's say these are the financial metrics you are tracking with your startup. It has EBITDA, say it's a business plan provided by founders. It has net income, it needs some CapEx. So besides being EBITDA negative, it still needs additional CapEx, right? So you have some free cash flow and you have some discount free cash flow in this case, already discounted with particular numbers. So your actually question here is, what are the company cash needs? And which line should we use here to get the number? How do you think? Yeah, free cash flow should be used for sure. It's the only metric which will actually show you whether your company is already insolvent or not, whether it has cash for paying salaries or not, and etc. etc. Good morning, just a moment. This can't take a seat. We're about to finish. So yes, this is correct. This is free cash flow. You have to combine the negative numbers. You don't need to take positive numbers into account, and you have exactly 1 million. This is just the answer, and that's it. And my question, the last one, is on anti-dilution protection. Did you manage to do it on yourself as a task assigned, or you think we need to consider that during our last seminar? Please let me know, okay? That was the formulas you should be using, and these are the 2 examples you have in lectures and in work. And take a look at the list of the tasks which will be on the exam. It will be about fund fees and carried interest, anti-dilution protection, drum and exit diagram, but maybe I will take it away. I will take a look on how you manage to do that. Of course, cap table, capital needs, timing of rounds, calculation of high IRRs, convertible note conversion, liquidation preference, and participation rights, as well as several valuation methods which we just covered today and during the lecture. And that's it for today. Actually, if you have questions, please feel free to ask. Okay, then thanks for attention, and sorry again for short delay. Unfortunately, traffic jams my program. We still managed to be on time and cover everything. Yeah, Maxim, of course, I'm always trying to do it in time. I will try to do it today during the week. I will put it into the Google Classroom.
Thanks.
And of course, yes, you're welcome. And of course, Victor, I will try to find your comment in Google Classroom. To be honest, I tried to do that yesterday. I was unsuccessful. I was just looking for any comments. I didn't find anything. Okay, then thanks, and until next time. Yeah, look, thanks for the question. Actually, I was in the middle of the process looking at your intermediate test. It was more or less the same as far as I thought. We will go into the worst tasks you've done. I think it will be bottom two tasks which most of you haven't decided, because the rest is more or less fine or quite good. Yeah, we will cover at least two tasks from there. Okay, thank you, take care, and bye-bye.